Breaking, silver just crashed 35% from $121 to $79. The entire market is calling this the end. But here's what they're missing. Mining stocks never moved. They're still priced like silver is at $50. Welcome back to the truth they don't want you to see. This is your no-filter update on the silver war happening right now, February 8th, 2026. What I'm about to show you is not speculation, it's math, and the numbers are screaming one thing. The trap is fully set. Subscribe and hit the bell because we're posting these updates every single day while this market is exploding. Let's rip this open. First, the battlefield status, so you understand what just happened. Silver detonated from $30 early 2025 to $121 on January 29th, 300% in 13 months. Then the trapdoor opened. 35% collapse in days. Margin requirements spiked overnight. Leveraged positions wiped out instantly. Algorithms turned cannibal. Panic flooded every trading desk. Silver crashed to $72. The headlines screamed bubble burst. Retail sold everything at the bottom. Then something strange happened. The bounce. Silver recovered to $79 and it's holding. Dead cat bounces don't stabilize like this. They fade fast. This one isn't fading. So what's actually happening behind the scenes? Here's the setup that has institutional traders sweating right now. Silver mining stocks never followed the rally. Look at the amplified junior silver miners. It's trading at $31 to $32 per share. When silver hit $121, these stocks barely moved. Now silver is at $79. The stocks are still at the same level. Their price, like silver, never left $50. Why does this matter? Because the profit margins just exploded. 2 years ago, at $30 silver, miners made $10 profit per ounce. Costs were $20, revenue was $30, 33% margin. Now silver is at $79. Costs have risen to maybe $25 with inflation. That's $54 profit per ounce. The profit went up 500%, but the stock prices up maybe 100%. That's a 300% gap. This gap cannot exist forever. It's mathematical suicide. So why are mining stocks still flat? 3 reasons. Reason 1, hedging contracts. Many silver miners locked in prices months ago. They hedged their production at $40 to $60 per ounce. It protected them from crashes. But now, it's capping their profits. The good news, those hedges expire in Q1 and Q2 of 2026. That's happening right now. When those contracts expire, the profit explosion hits the balance sheets. Reason 2, fear paralysis. Institutional investors are terrified of buying the top. They saw the crash from 121 to 72. They think it's going lower, so they're sitting on the sidelines waiting. But while they wait, physical silver buyers are accumulating. Eastern markets paid 25 to 30% premiums during the entire crash. Shanghai traders were buying while New York was panic selling. Reason 3, the market doesn't understand. This isn't a commodity rally. This is a currency event. The dollar is losing structural integrity. Silver isn't getting more valuable. The denominator is collapsing. And mining stocks are still priced in the old dollar framework. Now here's the part that makes this explosive. Industrial demand for silver is not stopping. Solar panel production needs silver paste in every cell. Electric vehicles need silver in batteries and wiring. AI data centers need silver in semiconductors. 5G networks need it for signal processing. None of these industries can substitute it. Physics doesn't allow it. And here's the trap. Supply is fixed. You can't just mine more silver because the price went up. New mines take 8 to 12 years to develop. Most silver comes as a byproduct of copper and zinc mining. If copper demand falls in a recession, copper mines close. When copper mines close, silver supply disappears. Even if silver is at $150 per ounce. So we have inelastic supply meeting inelastic demand, and the market is still pricing miners like it's a normal commodity cycle. It's not. This is the setup of the decade. The final piece, institutional capital rotation. Right now, global pension funds hold less than 0.5% in precious metals. If they decide to move just 1% into silver, that's $500 billion. The entire annual silver supply is worth less than $100 billion. Do you see the math? When pension funds, sovereign wealth funds, and endowments start moving, there won't be enough silver to buy. They'll skip the physical market. They'll go straight to the source, they'll buy the mining companies, and when that happens, these stocks won't rise gradually. They'll gap up overnight. 30% moves in a single session. 50% moves in a week, because there are no sellers who sells a company printing money at $54 profit per ounce. Here's what I'm tracking every single day. Hedge contract expirations from major miners, physical premiums in Shanghai versus New York, institutional fund flows into precious metals, ETFs, any government stockpiling announcements, and price action at the $79 level. If this holds and grinds toward $85 to $90 over the next week, the purge is complete. The weak hands are gone. The next move higher has clean fuel. This is not financial advice. Do your own research. Talk to professionals. But from where I'm watching these charts and data every single day, this setup looks like the opportunity of 2026. Drop your take in the comments right now. Is $79 the floor? Are mining stocks about to explode? What are you buying? I read every single comment. If this cut through the noise, share it with someone who needs to see it. And if you're not subscribed, hit that button now. We're tracking this war every single day. Thank you for watching. Stay sharp.